Hello, students. In the last class, we've learned the dividend discount model based on the constant growth DDM, assuming that the dividend uh, is growing the same growth rate forever. And then we simplify this equation into dividend 1, which is the future cash flows, divided by the required rate of return and minus the growth rate, right? But this video clip will be covering this non-constant growth stuff, because in the reality, even though the dividend is constant, but in the unforeseeable future, we cannot exactly measure the growth rate like in 10 years or 20 years. So we need to change the growth rate after certain years later and forever, right? So we are going to apply this the valuing the non-constant growth rate, like dividend 1, dividend 2, dividend h, which is the horizontal value of the or the permanent value after year h. Okay, so let's take this example. Tattletale News Corporation has been growing at a rate of 20% per year. And you expect this growth rate in earnings and the dividends to continue for another 3 years. So we'll apply the last dividend paid to with this 20% growth rate. If the last dividend paid was $2, the discount rate is now 15%, and the steady growth rate after year 3 is 4%, because even though the company has been growing a lot, now, like in a long-term view, usually the growth rate of this industry is now merged into the inflation or the GDP growth rate of the country. So we apply like the 4% lower growth rate, but forever. What should the stock price be today by DDM model? So let's calculate the dividend year 1 first. How to get it? So $2 times 1 plus growth rate 4%. So we have the 2 point, oh, sorry, it's not the 4%, 20%, right? So $2.4 is the expected dividend year 1, right? And then this dividend is also increased by 1 plus 20% next year, so 2.88. And then year 3 also increased by 20% once again. So those are the dividend year 1 to 3. But after year 3, from the year 4, this dividend is going to grow with this 4% permanently, right? So we can calculate the permanent value after year 3 at the end of year 3. How? Right, you're using the DDM model. The present value is equal to, now not the D1, now we use D4 divided by R minus permanent growth rate, right? So how do you get it? This 3.46 will be growing from then on. Right, now it's 4%. Now this is dividend 4 divided by discount rate 15% minus growth rate. So we got this, the present value at year 3, including the permanent value. Okay, so this the permanent value is calculated by the dividend discount model at the end of year 3 as well. Okay, so we calculate all this future cash flows. Now let's just combine all the future cash flows. Again, the year 3, we have the dividend year 3 and the permanent future cash flow after year 3. Permanent, the cash flows discounted by the discount rate with the gross rate after year 3, 4%, right? And then we got $32 is the present value at year 3. It's not the present value, but we can just apply the present value year 3 with D4 divided by dividend 4 divided by R minus G. Okay, so we got $32. So the $36 is the free cash flows, including permanent value. Then, how do you calculate this total, the future cash flow? Now, these future cash flows should be discounted by this discount rate. So, how to get it? We can just simply use the NPV with the rate, comma, the value, future value, and then $28. That means that we can also calculate in this way. $2.4 divided by, discounted by this 15% discount rate to the power of 1, and this 2.88 divided by 1 plus 15% to the power of 2, plus this $36.13 divided by 1 plus discounted rate. Now we need to discount by to the power of 3, right? So that we get the same stock price, same the intrinsic value. Okay, so the point of this exercise is that how do we calculate the permanent value, horizontal value after year 3? Infinite future cash flows with the growth rate, permanent growth rate 4%. It has been, this dividend has been increased by 20% with foreseeable future. But after year 3, we just assume that just humbly 4% is the growth rate. Then how do you calculate the future cash flows after year 3 forever? Now we can apply this dividend discount model. Present value is equal to D1 divided by R minus G. At the end of year 3, considering the future value after year 3. So the present value year 3 is the dividend 4 divided by R minus G, the growth rate after year 3. So we got this permanent value. Then all this, the future cash flows combined, then this future cash flows should be discounted by this discount rate 15%. So we got this stock price $28, or you can calculate just in this way. That is this equation. Okay, so see you in the next video clip. Bye bye.